Hi, and welcome to I Love Mortgages because I do. I'm Ann Coble, and I'm a mortgage broker in South Carolina, and I've been doing this for 26 years. So today I want to talk about self-employment bank statement loans. Bank statement loans are a great option if you're self-employed. Let me tell you why. One of the main benefits is, let's say you can tell your accountant, hey, show this amount of income on my tax returns because I want to buy a house. But then when you do, your tax liability is $100,000 or more. Well, you can avoid all that by using a bank statement loan if you're self employed. And you can use these loans for a primary residence, a second home, or even investment property. So, what is a bank statement loan? A bank statement loan is a loan based, and you can do refinances too, is based on deposits into your business account. So, let me tell you how to get set up for a smooth bank statement loan. You will need a CPA. You still need 2 years of being self employed. Now, your CPA is going to need to write a letter stating that you've been self employed for 2 years, stating that your business is in good standing, and also giving an expense ratio, which is important if they'll do that. Most accountants will do that for you. An expense ratio is, um, let's say we're going to add up all your deposits on the bank statement line. That's how we're going to derive your income. We're going to add up all qualified deposits and multiply that by an expense ratio. So the basic one is 50. But if you're somebody who has low overhead, you work out of your home, there's not too much involved, maybe your expense ratio is only 15%. So if your accountant will say that, that's great. And the other thing you want to do is make sure your credit is in order because the rates are basically the same as conventional. The other good thing about bank statement loans is that they don't have mortgage insurance. The one thing that's different is they require 10% down for a primary residence. And if you're looking at an investment or second home, it's going to be 15, maybe for a second home, 20, 25 on an investment property. So be prepared for that. So how do you get prepared for a bank statement loan? And like I said, we are going to calculate your income based on qualified deposits for a year. So, what I recommend is you start putting all of your business income into one account, and it should be a proper business account. That way, we can count most of the deposits and not have to worry about not counting income because you put it in a different account. So, all business income into one business account. Make sure you have an accountant who's willing to write a letter. Most of them will be since you're their client. And then make sure that you don't have any NSFs. You don't want to have any of those when we're looking at 12 months of bank statements. So most of these loans do allow for 12 months, some go up to 24. So it depends on how your income looks. Now, if there's a decline in your income, certain lenders have rules about that. If it declines by a certain amount, they're not going to average the deposits. They're going to go with some declining factor. So anyway, be prepared. Pick one account for your deposits because that's how we're going to calculate your income from qualified deposits multiplied by your expense factor. Get your credit in good standing. The rates are similar to conventional with no MI. The only drawback might be the 10% down payment, and then get your credit in order and save for your down payment. I do recommend maybe opening a separate savings account for that so that the deposits aren't questioned or they can season and it just might be easier bookkeeping. But put everything first into your business account. So I hope that was helpful. If you're self employed, these are great loans. And let me know if you have any questions. Thanks for watching. Hope that was helpful. Bye.